In this video, we're going to look at a different way of valuing stock. It turns that there seem to be some correlations between certain variables within the company's discretion and pricing. So we refer to these as multiplier models. And there's three of them listed here. The PE ratio, that's price to earnings, price to cash flow, price to sales. And there are more. In addition, away from price, there's something called the enterprise-based multipliers, which is the enterprise value divided by EBITDA. So we'll talk about these as we go through some of these slides. So the PE ratio reflects the amount of money investors are willing to pay for each dollar of earnings. So we have price divided by earnings per share. Now the PE multiplier approach tries to predict what this price will be based on the other variables. So we just do a little algebra here. The value, P sub 0, is the estimated earnings per share multiplied by the estimated PE. So this is going to give us a value sometime in the future. So if we have a 1-year estimated earnings per share and a 1-year estimated PE, this will give us a predicted price at the end, or when that year gets here, at the end of this current year, if you will. So let's see how this works mathematically. So we have this Lamar company that we've been dealing with. They earn $2.60 per share a year, and they have the industry average PE ratio is 7. Now the firm's per share value then, using this, again, it's a multiplier model worksheet, put in the estimated PE and earnings per share. This stock has an estimated value of 18.2. So the question is, well, should we use, what PE ratio should we use? Well, you don't want to use the current PE ratio because the estimated PE is obviously moving forward, right? So maybe you want to see if we can find a forecasted PE ratio. And there are publications that will give us what's referred to as a forward PE. That is an estimated PE somewhere down the road. Now, how that is calculated is beyond this particular video, but given the company's valuation and given the company's performance, we can use some ratios, etc., and predict what we think that PE ratio will be on down the line. So that's the PE ratio. So let's think about, again, there's the other multipliers that we talked about all work on the same basis, right? They all work in the same way. For the price to sales ratio, right? You're going to take that price to sales number. We're going to have to predict what we think that's going to be. And we have to estimate the sales per share. And then the sales per share times that should give us a prediction of value. And similarly with cash flow. So the basic models all work the exact same way. So let's think about managers and the decisions they make and how they can affect stock price. So let's think about changes in expected dividends. If you can increase, or if you suspect to increase future cash flows, value obviously increases because that's the cash flow that goes to investor. So any change that managers make that increases expected dividends without changing risk should be undertaken because the ultimate impact is an increase in wealth. But what about risk? if you increase the risk shareholders have to bear, you have to increase the risk premium. If the risk premium goes up, if risk goes up, what happens to value? Again, the required return is going to increase, and therefore the stock price is going to fall. So any decisions that we make that increase risk should be avoided, because by definition of the risk-return trade-off and by the formula itself, an increase in R will decrease the value of the stock. So management's decisions are critical, right? We need to understand something about cash flows. We need to have an opinion about what we're going to do with risk. And of course, there can be a combined effect, right? So any financial decision we make rarely affects just one thing, right? It's a combined effect. So it's difficult to think of a project right now, right, of how you could increase a project that would increase dividends but decrease risk. But if we can find those, the net effect will have an impact or an influence on what the stock price is. To kind of shift gears now, let's think about how we do this with preferred stock. So what is preferred stock? It's referred to as a hybrid security. Like bonds, preferred stockholders receive a fixed dividend that has to be paid before the dividends are paid to common shareholders. However, companies don't have to pay. It's not a contractual obligation like bond interest is. So again, it has the cash flows that appear like bonds. However, it does have the option that you don't have to pay if for some reason you don't want to pay. So here we have a preferred stock has an annual dividend of $5, sells for $100. What is their expected return? So the value of the stock, if you want to calculate the value, it's the dividend divided by the cost or the required return. We want to solve for this return. So in this case, you solve for return, the expected return on the stock is 5%. So what's the difference between the returns on equity and the costs of issuing equity? Well, here's where we're kind of going with this idea. This chapter is all about valuing stock, but it really has a feel of finding the value from the perspective of an investor, right? So the rate of return that you expect to get on the stock, right, it's part of this calculation. But let's kind of change the scenario just a wee little bit so I can try to make this point. If you go to the bank and borrow money, if they tell you you have to pay 5%, you have to pay 5%. That is the cost of financing, right? The 5% that you give to the bank is their return. So from a stock perspective, right, if you are buying bonds, right, you buy a bond, they pay you, in this case, let's say 5%. That's your return. And of course, that is their cost. And the point we're trying to make here is that if you don't think about taxes for a couple of minutes, they are the same numbers, right? The cost that's paid by the lender is by the borrower, the cost that's paid by the borrower is exactly equal to the return that the investor gets. They have to be equal. So when you think about equity, right, how can companies gather equity? Where does it come from? So profits or retained earnings is one place where companies can get money. They can reinvest the profits of the company into buying assets. In addition, they can issue new common stock. And then here's where I come to that point, right? Just like with bonds, there's always a cost associated with gathering funding. Now, with retained earnings or profits, it's an opportunity cost. But with new common stock, there is absolutely a cost associated with issuing funds or issuing stocks. So there's two ways we can determine the cost of retained earnings. Again, this is an opportunity cost. And we've discussed these before in this chapter, right? To find the return on stock, you need the dividend yield plus the capital gains growth rate. So this is D1 divided by P0 plus G will give you the return, that the opportunity return that goes to shareholders, which is indeed also the opportunity cost. In addition, we can use the security market line from the capital asset pricing model to calculate the return, the required return on the stock. And again, from an opportunity cost perspective, these numbers are the same for both the shareholder and the corporation. So this, the slides we're going to come up here in the next couple of minutes are in another workbook. And what I'm trying to do is try to consolidate some of our thinking so we understand two sides of the coin, right? We need to understand how the company thinks. We need to understand how the owners think. So this comes from a chapter on weighted average cost of capital, which will be in the next video or so. So you'll see these again. This is just more for knowledge sake, at least at this point. So here we have some dividends, right? Today the dividend was $2.98. $3.80 is the future value. 5 years is the time frame for this. So if we kind of look at this, we understand a little bit about the growth rate of dividends. The dividends for this company have grown at roughly 4.98%. So we've done these exercises before. So here we're going to look at this column here. So here we have a company. The dividend, the current dividend is $3.80. The growth rate's 5. The stock price is 50. If you look over here, we have cost of retained earnings using that dividend growth model is roughly 12.98%. Again, that's the return that shareholders would expect. So that's the opportunity cost to the corporation of using profits. Now we also can incorporate the capital asset pricing model information. So that's plugged in here. Risk-free rate 7, beta is 1.5, and we're saying that the market has an average rate of return of 11. So now here we look cost of retained earnings, security market line, 13%. Now, what we typically, there's other methods that we can use, but what we typically think about here is, these numbers won't always be, quite frankly, this close. But if they are, we can use the average. And if you look down here, here's the common equity retained earnings. The after-tax cost is 12.99%. It's just the average of the two. Now, if we want to talk about the cost of issuing new stock, we need to take that formula, our original valuation formula, so again, solving for R, but the difference is the numerator. The numerator is the market price minus something called flotation cost, because it costs money to physically issue the stock. So this could be for printing, for lawyers, etc. But there's also something a little bit different with stocks than there are with bonds, because stocks trade a little bit more frequently. So the idea here is, let's say that P&G wants to issue new shares, and you're interested in buying P&G stock. You can either buy the new shares or you can buy the shares that are already in the market. Which one do you want to buy? quite frankly, you probably don't care. But what does the company want you to do? They're issuing new stock because they're trying to gather money. They want you to buy the new shares rather than the old shares, but they have the same price. So what they will typically do is underprice the new shares. So if the stock is selling for 90, you may be able to buy this stock for $87, in which case you get an automatic $3 realized return on your investment. So again, the cost, it's the same formula. All we do is substitute net proceeds in the denominator. So here we see if we put in here the flotation cost right here, say it's $3.50. Now you see that the new cost of equity is 13.58. So in the end, what we're looking for is we're trying to figure out what are the costs of financing. In the bond chapter and the stock chapter, we've been talking about what are the returns for investing. And I didn't want to pass up on making sure we understand that you can also do this cost concept with preferred stock. So here we have a dividend is 10% of the price. So it's $87 is the price. 10% of that's $8.70. Now we've said that there's a $5 flotation cost on this stock. So again, over here you can see there's a cost of preferred, 10.61%. And since there's no tax associated with dividends to the corporation, the before tax cost and the after tax cost for preferred stocks are the same. Well, I hope you liked the video. I'll talk to you soon.